Discount rate has two different definitions and usages depending on the context. First, discount rate refers to the interest rate that is charged by the Federal Reserve Bank charged to commercial banks and other financial institutions for loans they take through the discount window loan process. Second, the discount rate is the rate of interest used in discounted cash flow (DCF) analysis to determine the net present value of future cash flows of a business. Discounted cash flow (DCF) is a commonly followed valuation method, used to estimate the value of an investment based on its expected future cash flows. Based on the concept of time value of money, investors, bankers, and company management use discount rate to judge whether an investment should be considered or discarded. A company only proceed with a new project or investment only if it is expected that the revenues are greater than its expected costs, or in short, if it is profitable. A relevant discount rate can only be determined after a firm approximates the project's free cash flow, then discount it to determine the net present value, NPV. If the net present value is positive, the project is considered viable. Otherwise, it is considered financially unfeasible. Types of discount rates. In corporate finance, there are a few types of discount rates that are used to calculate net present value of the cash flows. They include weighted average cost of capital, WACC, for calculating the enterprise value of a firm. Cost of equity, for calculating the equity value of a firm. Cost of debt, for calculating the value of a bond or fixed income security. A predefined hurdle rate, for investing in internal corporate projects. Risk-free rate, to account for the time value of money. Example. For example, $200 invested today in a savings scheme that offers a 10% interest rate will grow to $220. In other words, $220 when discounted by the rate of 10%, is worth $200 as of today. If one knows, or can reasonably predict, all such future cash flows, then, using a particular discount rate, the present value of such an investment can be obtained. Difference between cost of capital and discount rate. The cost of capital refers to the minimum rate of return needed from an investment to make it worthwhile and to satisfy its debt and equity investors, whereas the discount rate is the rate used to discount the future cash flows from an investment to the present value to determine if an investment will be profitable. The cost of capital and the discount rate work together to determine whether a potential investment or project will be profitable. The discount rate usually takes into consideration a risk premium, and therefore is usually higher than the cost of capital. Issues with discount rate. Calculation of discount rates and their use in financial modeling may appear scientific, but predicting future is based only on assumptions and best guesses. Also, an analyst or an entity generally uses one discount rate at a point in time to value future cash flows, which, in fact, is not as practical as risk and interest rates are constantly changing.